But overall, the supply of high-quality liquid assets is still enormous. According to a recent analysis by the Bank for International Settlements, the available supply is many times the expected demand for collateral. It will be important going forward, however, to look closely at the sources of that collateral and assess the ability to match supply and demand. This may become more important as regulations take effect requiring institutions to hold large amounts of safe assets and as some sources of liquidity, such as central bank asset purchase programs, are wound down. As a natural consequence of positive economic trends, the supply of safe liquid assets is likely to shrink in coming years. For example, governments in most developed countries will be reducing their issuance of sovereign bonds as deficits continue to shrink. In the United States alone, the annual increase in marketable U.S. government debt outstanding is expected to shrink from $1.1 trillion as recently as 2012 to $620 billion in issuance this year, a decline of almost 50%. Increased demand for safe assets was one of the factors that led Treasury to develop floating rate notes, the first new product issued by Treasury in 17 years. In conversations with market participants, it became clear to us that there was real demand for a term security that reset its interest rate on a regular basis and would therefore trade with relative principal stability. Issuance is still relatively small. We just began these auctions in January. But early results have confirmed that demand for such an instrument is indeed significant. Another potential policy development that will have bearing on this question of where market participants will source liquidity in the future is the reverse repo program currently being tested by the Federal Reserve. It's possible that market participants will look to the reverse repurchase program as a substitute source for safe assets. Some commentators have noted this feature of the program, arguing that it would help expand the supply of a potentially scarce resource. It's important to note, however, that assets borrowed under the RRP, at least as currently structured, are not permitted to be rehypothecated. Accordingly, those assets would not be available for use as margin or collateral, for example. Several structural changes are underway that are changing the way market participants interact and the nature of financial intermediation. For example, there has been a broad shift away from unsecured financing to secured financing arrangements, such as repo and securities lending. There's also been a trend towards increased electronic trading and increased use of central clearing. These evolutions in market structure are broadly positive. But as always, it will be important to closely monitor these developments and the changes that they themselves bring.